What's up guys, and welcome back to Wall Street Millennial. On this channel, we cover everything related to stocks and investing. One of the most notable trends in the stock market over the recent years is a so-called pandemic round trip. Companies that benefited from the pandemic saw their share prices skyrocket just to give up some, if not all, of these gains as the Fed started increasing interest rates. Companies previously thought to be bulletproof, like Amazon, have seen their share prices almost cut in half since their recent highs. However, there has been one unlikely pandemic beneficiary that's been able to hold on to its gains against all odds. Dillard's is a big box department store with about 300 locations, mostly concentrated in the southern United States. With growing competition from e-commerce, most analysts wrote the company off as a dinosaur that would eventually suffer the same fate as Sears and JCPenney. The pandemic appeared to be the final nail in the coffin as the retailer was forced to close its locations and its sales fell to almost zero. The conventional wisdom on Wall Street was that the coronavirus would accelerate the pre-existing shift from brick and mortar to e-commerce. Big box retailers like Dillard's would go bankrupt. But sometimes the conventional wisdom is shockingly wrong. Dillard saw its business boom and to date has increased tenfold from its pandemic lows. Over the past 5 years, this 80-year-old retailer has crushed Amazon, with its stock returning 300% compared to the e-commerce giant's 125% gain. In this video, or podcast if you're listening on Spotify or Apple Podcasts, we'll look at how Dillard's is eating Amazon's lunch against all odds. Before we dive into the video, a quick word from today's sponsor, Finimize. Finimize is an app that helps you become a smarter investor in 10 minutes per day, delivering all the insights and tools you need to make smarter financial decisions. Run by former employees of investment banks like Goldman Sachs and HSBC, Finimize publishes short and engaging stories that help you understand the biggest financial opportunities and invest like a pro. You can save hours of research time by opening Finimize. You can find everything from under-the-radar tech stocks, the latest developments in the economy, personal finance, and much more. As an active investor, I find their insights invaluable for keeping up to date with what's going on in the stock market and giving me more confidence in my financial decisions. For example, I recently read this great piece that they wrote talking about the growing cloud computing industry and the various companies that can benefit from it. They break down this complex industry piece by piece, making it easy to understand how the value chain fits together. At the end, they gave a breakdown of which stocks stand to benefit, including the semiconductor companies that enable cloud computing, the cloud service providers like Amazon and Microsoft, and finally the software companies that operate on the cloud. They host numerous private online groups and even live events where you can connect with thousands of other smart investors on the platform and share insights on everything from option strategies to new trends in green energy stocks. Click the link in the description box to get a 7-day free trial of Finimize and 40% off. Become a smarter investor in minutes. And now back to the video. Dillard's was founded by William Thomas Dillard in 1938 when he borrowed $8,000 from his father to start a department store in Arkansas. The store focused on selling high-end clothing. Throughout the 1900s, they grew by acquiring underperforming department stores, mostly in the southern parts of the United States, with Texas becoming their largest market. They would revitalize the stores and rebrand them as Dillard's, which became a household name in the Deep South. The key to Dillard's success was vertical integration. A large part of Tesla's success today comes from bringing as much of the manufacturing process as possible in-house. This reduces their dependence on suppliers and allows them to own more of the value. Dillard's pursued a similar strategy. In the late 1980s, they created their own construction subsidiary called CDI Contractors. They used CDI Contractors to build and renovate their own stores. Without having to rely on external contractors, Dillard's had complete control of the process. This allowed them to build new stores and renovate the stores they acquired at a very quick pace. They carry expensive name brand clothes, mostly catering towards women. Just about every clothing retailer has a problem with excess inventory. For any given item, you don't know exactly how many you'll be able to sell, and eventually it'll go out of style. So you invariably will have unsold clothes piling up on the shelves. Lower-end fast fashion retailers implement massive discounts to liquidate unsold inventory. But for higher-end retailers like Dillard's, they don't want to discount the items too much because this would hurt their image as a high-class establishment. To solve this problem, some super luxury brands burn their unsold inventory to keep supply artificially scarce. Others will sell it at discount retailers like TJ Maxx, which then sell them at much cheaper prices. But Dillard's had a better idea. They own their own specialized clearance stores, generally located in low-income neighborhoods. Any clothes that they can't sell in the main stores, they then ship to the clearance stores to sell for discounts of 60 to 80%. Most of the clearance stores are located far away from regular stores, thus they can avoid cannibalization. Because Dillard's keeps this whole process in-house, they keep all of the associated revenue, which is a big advantage. Despite these advantages, Dillard's also has some major problems. As the years went by, their department stores became older and older. Also, their interior design was lacking, with old-fashioned hardwood floors, disorderly shelves, and generally dingy store design. This vlog from YouTuber Sergio's Secrets shows shoes sprawled out across the floor at a Dillard's in Texas. This is not the quality that most shoppers expect from what is supposed to be a high-end retailer. From 2015 through 2019, their sales were stagnant as their old-fashioned store designs had trouble attracting new customers. From its peak in 2015, Dillard's stock price went on a consistent downtrend, which saw its value cut in half by the end of 2019. Investors viewed it as too old-fashioned and that it would eventually become irrelevant as consumers shift to online purchases. And then the pandemic hit. Governments around the world put in place stay-at-home orders and various other restrictions, making it almost impossible to run a physical retail operation. This would be disastrous for Dillard's, which had only a very limited e-commerce operation. Fearing the detrimental effect lockdown orders would have on their sales, Dillard's initially refused to shut down many of its locations. This location in the Houston area kept its doors open for a week after the local government ordered all retailers to shut down. They kicked out a local reporter who came to investigate. Dillard's was one of the only major retailers to defy government orders and refuse to shut down. A Change.org petition asking them to close their doors got 13,000 signatures, as people feared that they would help the virus to spread. Even though the stores were technically open, most customers were scared of catching COVID in the first few weeks of the pandemic, so they eventually caved in and closed the stores in April. Fortunately, their stores were mostly located in the Deep South in states run by Republican governors. These states relaxed their coronavirus-related restrictions much faster than their Democrat-controlled counterparts, and by midsummer they were more or less back to business as usual. And Dillard's also has some other key advantages. Namely, they had very little debt, and they owned almost all the real estate that their stores were located in. This meant that they had almost no interest or rent payments to make, and greatly reduced the chances that they'd go bankrupt. Many other retailers were not so lucky. As their sales volume declined, retailers like Gap were pushed to the brink of default as they didn't have enough cash to pay their rent. Additionally, their customer base is skewed towards elderly shoppers who aren't as tech-savvy. This limited market share losses to e-commerce players. And things would get even better. As the government rolled out massive stimulus programs, consumers had more disposable income than ever to splurge on clothes. Their sales quickly rebounded to roughly pre-pandemic levels by mid-2021. Given that revenue recovered to 2019 levels, you'd expect the share price to also increase back to that level as well. But not only did the share price recover, it more than tripled to make fresh all-time highs. So what happened? Consumers had so much stimulus money that they could afford to purchase items at or near list price. So Dillard's greatly reduced the discounts that they offered and their average selling price surged. This allowed both their gross and net margins to explode to 44% and 14% respectively, incredibly good numbers for the retail industry. So while their revenue only matched pre-pandemic levels, their net income more than quadrupled. In addition to strengthening fundamentals, there were also technical drivers supporting the share price. For the entirety of its 84-year existence, the Dillard family has controlled the company. The current CEO, William Thomas Dillard II, is the son of founder William Thomas Dillard. The grandson, William Thomas Dillard III, has the position of corporate vice president. Multiple other family members also hold executive positions at the company. The Dillard family owns roughly 35% of the outstanding shares in aggregate, and they very rarely sell. The company matches employee 401k contributions with Dillard stock. Because of this, another huge proportion of the shares are owned by regular employees. That leaves only about 25% of the stock available to the general public, a number which has declined substantially over time as they repurchase their own shares. The low free float of shares has made it vulnerable to short squeezes. So what is the outlook for Dillard stock now? Many investors are attracted to its low price-to-earnings ratio of 4.6, making it a deep value play. But the high earnings that we've seen over the past 12 months are almost certainly unsustainable. As people's stimulus money runs out, they'll have to start using more discounts again and profits will decline back to more normal levels. This will especially be true if we fall into a recession, as many economists are now predicting. The meteoric rise in Dillard's share price is a combination of many factors. It was probably undervalued pre-COVID, as fears around e-commerce and the death of the mall were overhyped. Secondly, they were a huge beneficiary of COVID stimulus. And thirdly, the free float is small, allowing a small increase in buying pressure to cause massive upward pressure on the price. Given that they own their own real estate and have almost no debt, Dillard's is here to stay as one of the biggest retailers in the Deep South, but the temporary explosion in their profits is likely coming to an end. Alright guys, that wraps it up for this video. What do you think about Dillard's? Do you think they can maintain their momentum? Let us know in the comments section below. Also, don't forget to click the link in the description below to get your 7-day free trial and 40% off your Finimize subscription. As always, thank you so much for watching and we'll see you in the next one. Wall Street Millennial, signing out.